Hi, Travis Jensen here with another simple question. Today's question is a fun one. It's how do you know when to get in and out of the market? Sometimes we get that question, so let's unpack that. This is a hypothetical example of a $10,000 investment over the last 10 years in the S&P 500. The furthest left bar, that's the result of that investment. So 10,000 over that last decade, it ends up being around 33,500. What do we have over here? These are bars that show if you miss just a few of the best days. So for example, if we miss just the 10 best trading days in that entire decade, we end up with approximately half as much money. Well, we don't want to do that. So how do we do that? We stay invested in the market. Our conviction is not so much in timing the market, but about time in the market. So the allure of the markets with the known volatility is that when we look at it, we think we should be able to get in at the low, out at the high, and rinse and repeat. The issue is we don't actually know when those pivot points occur. And what we've seen is dramatic turnarounds. So when we feel market volatility taking our portfolios down, we've actually seen, and we just saw it here with the Iran situation, very rapid turnarounds. So let's look back at the 5 biggest declines in the S&P 500 since 1987. Most recently is the COVID-19 sell-off. Very short-lived decline, but it was painful. At one point down 34%. Very tempting to get out, let it find a bottom, but what have we seen? If you waited 1 year, you're back up 78%. If you wait 2 years, you're up 105%. This lends credibility into our consistent approach of being in the market or time in the market in lieu of timing the market. I hope this helps answer any questions or clear up any thoughts. If you have questions, reach out. Also, if you have your own question that you'd like featured, feel free to reach out with that as well.